It's time for Ask Mike Mondays. Mike answers one listener's question every week. Here's Michael Becker and Paul Peebles.
Welcome to Ask Mike Mondays. I'm your host, Paul Peebles, National Underwriter for Old Capital. And Heidi Ho, it's the man himself, the legend, the governor of the great state of Texas in the real estate department, Mr. Michael Becker. Michael, how are you?
Hey, Paul, doing pretty good. Back at my desk for the first time in a while. Been traveling all over the place.
Yeah, you and I have not spoken anytime recently, but we saw each other out in Las Vegas. And so just very briefly, give me your 2 cents. I mean, out at the National Multifamily Housing Council meeting out in Las Vegas last week or 2 weeks ago, just more people that I thought were gonna be there, were there. What was your takeaway from being out in Las Vegas?
Well, got left with more money than I came with, so that's a rarity, right? Got a hot hand on the dice table a couple of times, so that worked out well. But
that's great.
But yeah, no. Speaking about multifamily, I think like you said, it was I think the largest attended one in history. There's a ton of people. I think everyone actually came out of that pretty well behaved, I think, for the most part, and just had a bunch of conversations. It was a little weird because there was a big giant ice storm back in most of the country, so everyone was kind of worried about getting home and scrambling home. So it's kind of a little bit disjointed and fragmented with some of the people trying to move around the schedule. But the people I talked to, I think kind of really my main takeaways or the consensus, I guess, would be that I think that the banks want their money back. So if you have a balance sheet bank loan, the regulators are banging on them. They need to get payoffs. So as a result, the construction lending is starting to really kind of dry up because they don't have a lot of capacity to make new construction loans because their loans are on the books longer than they're anticipated, and they're going to be on there for longer than anticipated. So until they get some payoffs, there's not going to be a lot of construction lending from the banks. It seems like the debt funds are largely on the sidelines. There's not a lot of debt fund money out there. So you got your Fannie, Freddie, Lifeco, or kind of your active lenders in the marketplace right now. So seemingly that, I think, as far as everyone's thinking there's going to be some pain that's got to be felt in the marketplace, in particular maybe in the workforce housing. But there's really not been a lot of that stuff kind of come to market. There's still a pretty decent bid-ask spread between what the buyers are willing to pay and the sellers are willing to take, especially in the workforce housing space. So there's virtually no inventory out there in the major Texas markets. And that's, rare because launching in January is a natural time for having deals on the market at an MHC conference. And there's basically, next to nothing on the market. And, the four majors, and at least the three that I pay attention to, the four majors in Texas, is just very little inventory. And it seems like we're all kind of waiting for, if you're a buyer, wait for the sellers to blink or vice versa. And everyone kind of thinks that the second half of the year will have more volume than the first half of the year. And everyone kind of, has a bunch of liquidity, or there's a lot of groups with a bunch of liquidity waiting to go be opportunistic. So I'm not sure how bad it gets because there's going to be a lot of liquidity out there. So that's kind of the consensus takeaway that I had. And just kind of talking to a few other guys, that was kind of the general feedback. But, maybe a little bit more optimistic and bullish than I think I thought maybe walking into this. I thought it'd be, all negative. And there's a lot of people that still believe in the fundamentals, and especially the Sun Belt in Texas. And those are the people I were talking to. Might be a little different if I was in, San Francisco than in Dallas. It might be a different story with the people we're talking to, but people want to buy. I think they recognize it's a moment in time and try to be opportunistic. But there's just really not much inventory right now. That's really kind of one of the main takeaways. Everyone's shocked with how slow it is from that standpoint.
Now, you guys are you guys still buying? Are you still selling? I mean, tell me a little bit about what SPI is doing these days, just to give people just a kind of a sense of the market and what's going on out there.
Yeah. So last year we were net sellers last year. We sold like 9, bought 3, I think. So we're about 3-to-1 net sellers in 22. As we talk right now, we have 2 deals about to close that we're selling, and we just got awarded a deal to buy, which will be a 1031 for a deal we sold last December. So we're selling 2, buying 1, trying to buy some more. So hopefully you'll be a net buyer this year. That's the objective. I think we've kind of sold what I want to sell. So not saying we won't sell 1 or 2 more extra that just, for whatever reason we decide to, but generally speaking, we're hopeful to kind of net out maybe 6 or 7 additional deals of what we started the year with. that's kind of the hope. I mean, I think we saw the valuations were insane in the beginning of the year. Sold a few deals, sold a couple extra deals along the way at not peak pricing, but still pretty good pricing. And I think we kind of cleared out most of the older stuff. Once I sell this one of the deals I got at escrow now, I think we're down to 180 deal left. And I don't know how many I had at one point. We've had 30 plus at one point, so we're down to 180 deal left. So everything's kind of younger in the portfolio. So I think we've kind of successfully repositioned it. And I think that if the consensus, which I'm kind of part of, plays out, there's a little bit more opportunity in the second half of the year in the workforce housing space. We'll probably go back and buy some older deals that we haven't really participated in a large scale the last seven years or so. So wow, I'm optimistic. Hopefully we're doing that. I mean, we've been kind of taking the last several months and just getting kind of the house in order, which we could talk about a little bit more too, just kind of making sure that we're taking care of the housekeeping that we have on the deals that we have and we're going to own, so we can then, get our backs clean so we can be opportunistic if there is, some significant dislocation in the marketplace.
Now, what does that mean, housekeeping in order? I know that you guys, or you had told me that you guys changed your IMS system or your systems that the investors see. That's been a big deal. Do you see that being a big help for the next round of purchases?
Yeah, we switched over our investors software. And so took probably 3 times as long as I thought, and probably cost twice as much money. So that's been going on in the background for over a year now. That's finally getting implemented. So that's been a big thing. That really doesn't involve me too much in the day-to-day. It's more my team than me. So we got that done, but that should hopefully streamline reporting and equity raising and all that good stuff. So everything should be a lot more efficient. At least that's the theory of why we bought off on this thing. So we'll see how reality is. But I kind of more talking about just, the deals we sold, the deals we wanted to sell, Paul, and probably a couple we didn't intend to sell. We just sold anyways to make sure we, got a couple deals on the scoreboard, generated a little bit of liquidity, and made sure that we kind of have the house in order. I was kind of more discussing, we had some early in the career, did a lot of fixed rate debt. Mm-hmm. And then the last several years, like a lot of people, did a lot of floating rate debt. So we had a few, several of the deals have interest rate caps. Some of them didn't have interest rate caps, so they're floating. And so, we kind of went, deal by deal and, did a pretty big analysis in Q4 on, okay, how do we get, into 2024 at least? And, do we need to cash call a couple things? Do we need to, refinance a couple deals? Do we need to sell anything? So we've been kind of going through that exercise, and we think we have 4 or 5 loans going right now that we're refinancing a handful of deals that are all about to start closing. So we've been kind of working through that process. So we have a few more to go, and we did a couple cash calls, and you just trying to. My mentality was I wanted to be the first guy with my hand out. I didn't want to be the 5th or 6th guy with my hand out. So if we needed to raise a little bit extra money to shore up the working capital in a deal to be in a position to repurchase a rate cap at the end of the year when the initial term of a lot of our rate caps start coming due, we just wanted to make sure we had a plan in place and got all that handled. So that's really what I've been doing a lot of the last, say, 4 months, Paul.
Yeah, you guys have been very active. I mean, the last year or 2 or 3, you guys have been, as I would say, team float. These new transactions that you're doing, are they floaters? Are they fixed rates? Are they Fannie Mae? I mean, are they Freddie Mac? Tell me a little bit about just 1 or 2 deals and how you structured them recently.
Yeah, a little bit of everything. So the deal that we're buying. So take a step back. So up until just the beginning of the year, the way Freddie and Fannie were sizing their SARM program, structured ARM, or the floating rate program, they basically would size off of a fixed rate equivalent. So they would see what an equivalent fixed rate would be on the 10-year term. And that's like your sizing rate. And then I think they realized that, well, hell, the pay rate is higher than the sizing rate. And so we need to stress that. So that changed, I believe, in January. So it really took a lot of basically they just slammed the brakes on the agency floating rate program in January. So that's becoming much more difficult to do and getting any sort of reasonable leverage on. So they're basically forcing people into the fixed rate. What I've learned from 2015, 2016, 2017, when we did a lot of 10 and 12-year fixed rate debt is, that was what kind of an untightening cycle, generally speaking, in that time frame. And then when the course reverses, you get stuck with large prepayment penalties. So I don't want to get into that. So what it seems like the kind of the solution that we're working on is, one, we started 2 refinances in December. We got grandfathered in. So we're going to go two of our deals, go float to float. So what's the benefit of that is we put a couple loans on in 2020. They were 10-year deals, 5-year IO floating, and they had spreads in the high 200s over LIBOR, SOFR, or it might have been LIBOR at the time. So, you're like 2.8% or give or take over LIBOR, and they had interest rate caps that capped the all-in rate at around, say, 5%. So you'd buy a LIBOR strike or SOFR strike for like 2.2% on the cap. So whenever LIBOR or SOFR goes above 2.2%, the cap kicks in and synthetically fixes you at 5%. And so those are all 3-year caps. And now, as we talked about on previous podcasts, the lender escrows have jumped quite a bit because they're making you repurchase a 2.2 strike when SOFR is like over 4% now. So that's way in the money and it's really expensive. So the benefit is we are going to, one, lower the spread. So we lower the spreads to the low 2s. So from the high 2s to low 2s. And then the max strike on the cap, the lender's going to make you purchase is like around 5%. So we will purchase a lower cap when we refinance it and probably make it a 5% all-in pay rate like we currently have. But the monthly impounds the lender's going to base their escrows off of are based off of a 5 replacement strike, a cap at a 5% strike versus, say, a 2.2% strike. So the economics of those are much better. So we think the rates are going to roll over at some point in the next 2-year period. So we don't need to escrow all this money. So that's a way for us to kind of kick the can 2 years down the road, free up a ton of monthly cash flow that is currently being sucked up by the lender into escrows. So that was kind of a solution on 2 of those deals, Paul. That's probably not executable today, just with the change in the way they're sizing. So I don't know if that's a executable strategy. So what seems to be working is going to 5-year money or 7-year money. The Fannie and Freddie always had really strict exit tests on the 5-year rate in particular, not so much 7. But since they had shorter term from the origination to the maturity, they sensitize the exit. So they'd be a little bit more conservative in the amount of loan proceeds because they don't have as much time to make it up through amortization or whatever. But it seems like they're starting to give waivers and get a little bit more aggressive on the 5-year money. So they're trying to force people away from floating and put them in 5 or 7-year. So that you can do that. You can also buy down for the yield maintenance. You buy down the yield maintenance 2 years. So if you do, a 5-year loan, you'd have typically 4.5 years worth of yield maintenance. You can buy that down to 3. I think it's about 25 basis points of the spread. So there's some of that. But what we're doing on 2 other transactions that we're refinanced. So we're doing, one's a 5-year deal, one's a 7-year deal, both with life cos. And then one of them has a 2-year yield maintenance and a step down prepay. And then the other one has a 2-year lockout and then a step down prepay. So we basically are stuck in the deal for 2 years, and then we have flexible prepayment after that. And so these are deals that have either maturities or rate cap coming up that are going to be pretty expensive. So these are ways for us to it's like a middle approach is kind of what I'm thinking of. You're paying in the kind of that mid-5 rate fixed, but you're not getting stuck in yield maintenance for 7 years or 10 years like we did back 5-6 years ago, which could be, exceedingly expensive. So you pay a little more now, you avoid the rate cap, which is pretty expensive. But then, after 2 years of rates come in, then we can refinance to get another bite at the apple and not just get absolutely crushed with the prepay expense, which is what we're trying to learn that lesson from a few years ago, not repeat that mistake. And then finally, the new acquisition we're going to do on the Upplug 1031, that's going to either be a 5 or 7 year fixed, ball. We haven't decided. We're getting our quote in today, but it's going to be 5 or 7 year because the floating rate proceeds are materially worse than the fixed, and we'll go likely with Fannie Mae on that.
Talk to your loan specialist either at Old Capital or your favorite loan company out there to get more information about how those transactions are put together. Michael, who is a former banker, he's not like the normal Joe Bag of Donuts. He knows his stuff inside and out, and that's where you want to be when you're having a discussion, not with the banker. Have the banker be the educator to you so they understand. So you understand exactly what's going on. So spend some time of kind of spending with your loan officer so they can educate you so you can talk to your limited partners about.
Do we need to unpack that? I was talking a lot of jargon there. Do you want to unpack anything I just said? So I don't want to talk over everyone's head, but there was some takeaways. What were your takeaways of what I just said, I guess?
No, they can roll that back and just know that Michael Becker is the smartest guy in the room. So let's just keep it at that. So you've traveled down to Houston recently and Austin recently. Of course, you're based out of Dallas. What is some of the general consensus is from people that are in Houston, Austin, and just Dallas on the A class, and maybe we'll talk all the way down to the B and C class type of stuff too.
Yeah, so we don't own Houston, but I went down. So we bought a property last year from a developer. They're based in Houston, so we had a meeting and then closing dinner with them, which was great. Hopefully to repeat some transactions with them is kind of the goal of that meeting. So I think takeaway one is just I think stuff like that still matters. I know we're out of the lockdown and all that stuff, but I mean, this is a belly to belly business in a lot of ways. Getting to know people, get networked, going to the NMHC, going to sellers' offices, things like that. The broker who sold us was there. We got a bunch of good quality time in with them as well. That stuff matters. And then if you're getting in a jump ball situation, that might tip it your way over the next buyer's way. So I think that's one foundational thing I'll just kind of repeat. But talking to this developer, they're a very large developer, probably if not the largest in Texas, one of the largest in Texas, and very active throughout the Sun Belt. They have a better cost structure than your middle run developer that builds 5 or 10 deals or 2 or 3 at a time or whatever. So their costs are better, but generally speaking, we haven't seen construction costs come in too much. So I think kind of just generic garden, Texas, suburban locations. Obviously, there's some variables in there and land and density and this and that. But just kind of generically speaking, it seems like construction costs of a 3-story walk-up garden deal and, one of the 4 majors in Texas, you're probably somewhere in the 220 to 230,000 a unit range. Seems to be kind of your construction cost on the kind of generic suburban wrap product. So when you have a parking structure, you're probably like 250, 260 a unit. So it's kind of your baseline. That's really it. Construction lending is very difficult. As I kind of mentioned when we started this recording, that's really hard. So it's really putting a pretty big governor. And then as we've seen kind of rents, the disinflation in rents, these deals aren't with more equity down, higher interest rates. The costs really haven't come in. I think we're starting to see supply pull back. So I think what you'll see is, the deals that are going under construction, capitalized, have a loan, they're going to get built. So those will deliver in 2023, probably 2024. And then as we get to the latter part of 24 and into 25, there's going to be a big hole in supply. So, with all these deals that are being built have to get through the system and get absorbed. But there's going to be light at the end of the tunnel. So if you own, multifamily, there's going to be a lack of supply hitting the deliveries in 25. So I would, put money on it right now that 2025 is going to be one hell of a year for rent growth, just due to that fact, especially if you own anything that's kind of, 10 years or newer for sure. So that was a takeaway. Kind of my trip to Austin, we're buying a deal, the deal we're buying is in suburban Austin. And, some of the takeaways, really, I think there's just no inventory of any note in Austin. I mean, there's very few deals on the market. I think you're seeing the bid-ask spread's real. So you've got a lot of interest, a lot of capital coming there, and there's just nothing on it. So cap rates have you got to make fundamentals work in this and that, but the lack of supply is really putting the ceiling on cap rates. I think all the buyers want to be north of 5 on a cap rate on, a nicer deal, and probably north of 6 on the older, tougher workforce housing deals. And the lack of supply is really putting a governor on that. So I think, Austin, you're probably in that 475 on a trailing basis, and you get to north of a 5 cap year one. That's probably where the market is. You're not hitting a trailing 5 cap. That's just not really anything that's, kind of A- or newer in Austin. I'd probably say that's the same in Dallas Fort Worth too. Saw a couple of deals, several deals kind of hit the mark. There was last of December, there's a bunch of deals that came out, or early January, a bunch of the Blackstone B-REIT deals hit the marketplace, and those all just kind of attacked. I mean, there were 33 bids on most every one of those deals. So there's a ton of money chasing those types of deals. I saw up in Dallas Fort Worth, there was several Cortland deals that hit the market. I think they bought the Steadfast REIT. So I think a lot of those kind of came and hit the market this week. So we'll see kind of how all those go out in price over the next 30 days or so. So yeah, so a lot of willing buyers, not a lot of willing sellers. I think that's Austin, San Antonio. I think that's Dallas, Fort Worth as well. I think basically what a lot of buyers are looking for being included, if you could buy below replacement costs on something that's, relatively new, you just have to take that high 4 cap. Hopefully you move the cap rate over the first year or two to, north of 5. So if you're borrowing money at, kind of mid 5s, which is what the marketplace is right now, and that 5.7-year money, and you're buying at a 4.75 cap, you're still negatively arbitrage that first year. So you're hoping to get year one effective cap rate once you move your rents, implement your business plan to kind of your debt level. So that's why we're trying to not take inflexible debt and have the ability to kind of right size it once rates come in. The institutional guys are still largely on the sidelines. So a lot of this is kind of family office, private capital chasing a lot of these deals. So I think finally, really kind of one of the last takeaways is, property taxes are, not quite the hot button they have been. I think we all expect to not get absolutely smoked like we had the last, 4 or 5 years in Texas when we get reassessed in April. But what has become a real problem is in insurance. So with, I think, the escalated replacement costs and there's just a bunch of weather events throughout the country, we're seeing more and more upward pressure on insurance cost. And so I think that's probably the most pressure we're seeing in OpEx right now, Paul, is just kind of insurance costs. So that's a real thing across property grades, across, I think, most of the markets of the Sun Belt.
Any solutions on the insurance? I know that we've had less.
You tell me.
Less carriers coming into the market. Carriers are fleeing the market, and what we used to underwrite deals at $350 a door for insurance on an annual basis. Now, in some cases, like down towards the coast area, and especially in Florida, it's $1,500 a door for insurance on an annual basis. So so Mike's absolutely correct. That has really been an issue. And especially if you underwrote the deal at $350, $400 a door when you originally had taken out the loan, and now you're trying to either refinance it or figure out what your debt yield is going to be to hit that hurdle to get an extension on your bridge loan from years 3 to 4 to 5. And you have to hit that threshold of a debt yield, and you throw that $1,500 a door into it, it becomes definitely challenging. So finishing off the end of the year here, what are going to be the problems in the B and C space with these bridge loans? And, is there anything that people can do? What do you say?
Listen, I think we got a lot of dead bodies and they just haven't fallen yet. I of course, I'm the boy who cried wolf. I thought there'd be problems before this, and we've gotten to this point. And then that's, I think, consensus too. So maybe everyone's thinking the same thing, so it doesn't play out exactly this way. So we'll see what reality is. But I mean, listen, there's a bunch of groups got real aggressive, put 70-75% debt fund 3-year bullets on them. So you got 3-year maturity in late 20 and early 21. And then they layered, pref up to 85-90%. So they're fully levered up to 85-90%. You bought a lot of those deals in, say, 2021, and you bought a rate cap. And so your spread was, say, 4% or 400 over SOFR. So your rate cap's kicked in. So your pain's kind of minimized a little bit in the near term, because maybe your rate went from 4.25 to 6% or wherever your strike on your SOFR strike kicked in. So you're not getting buried day to day because you got the rate cap kicking in. And then these debt funds didn't have a provision to make you escrow for a replacement cap like the Freddie Mac or Fannie Mae floaters did. So on Freddie Mac and Fannie Mae, if you had those, which is what basically we borrowed, we've been feeling the pain along the way as they upwardly adjust the monthly impounds every 6 months to make sure you have enough money to buy a 2-year replacement cap. Where these 80s deals or 70s deals that were like 85% levered, they don't have to feel that pain. So they gonna have to buy a replacement cap if they get an extension, but that's not going to come until the end of 2023 or maybe 2024. And then all of a sudden they're going to have $1 million or $2 million expense. They don't have the money for it. And then, the cap rates have expanded, and a lot of these guys bought these deals maybe with a 3 handle on the in-place to trailing cap rate, or maybe a low 4%. And now if they wanted to go sell it, call it 6%. And so if you only had, 15, 20% equity in your deal, that's long gone. So your probably current value is less than your debt basis. So those guys are like, listen, I ain't selling, because if I sell now, I lose all my money. If I sell in the future, I lose all my money. So I'd rather just hold out and hope that that the values will come back up, and I'll deal with my problems in the future. And they're not being forced to recognize the problems because they have that rate cap in place, and they don't have to impound for the replacement. So I think when those go away, that's the moment, right? That's when we see inflection. So, if you bought a deal in early 2020, you move rents, you might be okay. You buy a deal before COVID, you're probably okay. You got a fixed rate mortgage with no term on it, you're probably okay. Or if you got a floater with no term on it, as long as you can buy that replacement cap, you're probably going to be okay. But if you took a high levered debt loan, you layered pref in, you did that in 2021 with a business model to move rents 20%, you're fucked. I think is to be blunt, Paul. That's what I think is going on below the surface. It just hasn't come to fruition. Yep. That's why there's no inventory, because they're going to lose all their money now and lose all their money in the future, and they're just hoping that something changes. So that's my crystal ball. I don't know if I'm right or wrong, but that's what I think is happening.
No, I think I 100% agree with you on that. We've been concerned about that for a number of months, years, and it kind of is what it is. And just be careful out there, so to speak, as we always say on these type of transactions. Continue to communicate to your limited partners about what's going on. And I think the guys over at SPI, I think they do a great job of. Mike does a little bit of a narrative every month when he pushes out what's going on with the financials. And, Mike doesn't hold back with the financials. He shows exactly what they get from the management company, because they use a third-party management company to oversee their assets. So, they're not 100% into the weeds by trying to manage people and manage different assets. They put the professionals that do that to and held to the task of getting it done correctly. But as an investor, you see the canceled checks, you see the bank statements, you see everything. And that's what you want to see when you come. And again, I'm not advocating for Mike and SPI, but I'm advocating for the industry to be 100% transparent and protect the limited partners about what's going on, and just be 100% communicative to everybody that's involved in these transactions. We're going to have JP Conklin come in on March the 22nd. I think that's the next rate increase. So the day that they're going to be raising interest rates one more time, I'm hoping that that's the last one. Mike is going to be speaking with JP Conklin at the Grapevine Convention Center. We want you to be there on March the 22nd. Go to the oldcapitalpodcast.com, oldcapitalpodcast.com, and get yourself RSVP to that. That will probably be 300, 400, 500 people there. So get your reservation, because if you don't, you can't get in, because we're restricted how many people can actually be in that room. So make sure you get your RSVP and show up for that, because I think that's going to be a great opportunity to listen to where interest rates are going to go. And JP with Pensford, if you listen to his podcast, he's excellent about what his prognostication is. And there'll be an opportunity to network and listen to other limited partners about what they're seeing, and general partners about what's going on. And then you'll have a chance to meet hopefully Michael Becker at that period of time too, and some of the guys from Old Capital that will be there, and maybe some brokers that will be there too. But a lot of folks will be there. Anything I left out on this?
Yeah, I think just kind of summation, right? I mean, I think my main message today is, if your problems if you have problems, aren't going to get better by putting your head in the sand. So I think it's just recognize them. If you can call some cash if you had to in a deal to get on the backside of it. Obviously, I think there's going to be the bifurcation of the marketplace. We've been talking for years and years how it didn't make any damn sense for Class C deals to trade at the same cap rate as Class A deals. And I think we're seeing that reflect in the marketplace as we move through this. There's definitely a reversion to the norm, where cap rates of Class A are a lot more sticky than the workforce housing. So you're seeing that happen in real time, and if you need to, make a move, I'd make it sooner than later. I think you'll probably see a little more pain in the workforce space later in the year than you do right now. So if you get a deal out if you need to. But, I think we're, it's not a straight line. This is a business. It's cyclical. We're experiencing, we've had We had summer for a long, long time, and have a little winter. I think it's going to be pretty short. So get your house in order. Take advantage of these opportunities. I know I don't know how many people you talked to, Paul, but you talked to a lot of guys that kept saying, I'm going to wait. They probably started saying that. And, I think we both know some guys that started saying that in 2015, 2016, that missed a hell of a run here. So, but I think the fundamentals are still solid, especially if you're in the Sun Belt, especially if you're in Texas. I mean, people are going to move here. There's going to be housing demand. There's going to be a hole that's coming that maybe you don't see on the headlines for another 12, 18 months. There's a hole in supply coming. And if you get yourself positioned ahead of that, you can make a hell of a lot of money. I don't know how large this window is going to be because there's going to be quite a bit of liquidity that's going to chase it. So that'll mute probably the downside to some effect. And if, what goes up can come down. So these rates can reverse pretty quick. And you guys listen to JP, he'll talk about that quite a bit as well. So I think you just, make sure you get your financial house in order. Make sure that, you're ready to take advantage of opportunities. And I know it's going to be a little uneasy at that moment in time, but the best deals are about to be had in a long time. And, if you have the gumption to go invest in some transactions, I think anything you buy in 2023 is going to be proven to be pretty damn good buy in the not too distant future. That's what I'm hoping. We're hoping to be offensive, take advantage of all this opportunity. And, I think that the whole saying of survive to 25, that's probably what you need to position yourself in your portfolio. And if you buy in 23, you buy in 24, I think you're going to make, just a ton of money. I think that's what I expect to happen. That's what we're going to bet on. And if I'm wrong, I'm wrong. That's what we're going to bet on. And, keep kind of buying more of the same. And then maybe pivot a little later in the year or into 24 to buy some of the opportunity I think that's going to come in the workforce housing space.
Well, that sounds great. So some great information and some great theses from Michael and his group over at SPI. Certainly do appreciate Michael coming and spending some time with us. Again, Michael Becker, thank you. I'm Paul Peebles. Have a great day.